Hi everybody. We're going to continue today with chapter 9 on the income statement and the statement of cash flows. And in this first presentation, we'll go over the details of the income statement. So with revenue, the main thing about revenue that comes out is that we recognize revenue when it is earned and when essentially it's realizable. So that means one thing is that whatever we have sold essentially has basically been earned. In other words, I know we use example a couple of times. Say you got rent revenue for renting out an apartment. It's earned when you've given the consideration on your end of the contract. In other words, the apartment for that month. So it's basically earned when that month has gone by. In the fashion world, of course, you earn your revenue when you sell a piece. You don't say somebody says they might buy something or a bunch of orders from you. That's not necessarily revenue. That's the threshold actually is, hey, when you've given up the goods in this situation, that's when you have earned the revenue, and it's realizable when it's basically exchange for cash, or somebody gave you a card and that is earned, whether it's credit card or whether it's check. You can that is also considered earned. Of course, we'll go into some details further about if something happens. The journal entry, which I know we have done as well, is essentially we debit cash, credit sales. We've done it a bunch of times, I think, already. Um, Net sales versus gross sales, I think, it's more mechanics, but actually, if you look at the books, with retail and fashion in general, this is very applicable. You could have your gross prices, which are never really your net prices because there's always discounts, which you guys read and wrote a lot about last week. So discounts come off. Then you have returns that come off, and then allowances and allowances in general. We basically say how many people won't pay you, and I think now it could be dealt with, with the credit card, say Gap or J. Crew, if they have their own card, the allowances are basically the fact that people didn't pay off their card. If you manage it that way, and then you have your net sales after that. But usually I think there are no allowances at stores that don't do cards, because in a way, if people pay you, they pay you. That's it. Or if the card company paid you, they paid with a card, I'm sure you get that money from that vendor. Um, in terms of shipping, this could also be important. When is the ownership transferred? Um, Basically, FOB, ownership transfers to buyer when merchandise is passed to the carrier and the buyer pays the shipping cost. And basically, when the ownership transfers is when the who owns it at shipping, basically, is the idea, as opposed to FOB, destination. Ownership transfers to buyer when merchandise is passed to the buyer and the seller pays the shipping cost. So basically, of course, if you're a buyer, it's better to be FOB, destination. Ownership transfers to buyer when merchandise is passed to buyer. So that's the idea with shipping is, of course, we know that, when stuff is in transit, anything can happen. So, but as you also have insurance, and it's kind of just a minor detail, and more depends on the structure of the company and their vendor. Cost of goods sold. The idea of cost of goods sold is basically an idea that we discussed a couple times already, but in this case we're talking about how do you figure out a periodic inventory system versus a perpetual inventory system. And with the periodic inventory system, which honestly you wouldn't really be using this any longer, especially in a fashion business, because simply we are now managing things using systems and perpetual inventory systems. So I think that going forward, this is not even going to be applicable. And with how inexpensive it's gotten to track inventory and how useful it is, that most businesses will have perpetual inventory systems. And with perpetual inventory, what you do is you really just every time you sell something, you update the records in the management system, which is also the inventory system of actually um, increasing your expenses by the cost of the goods sold that you just sold and reducing inventory. So it's a debit to cost of goods sold and a credit to inventory. And this is just the beginning um, of our income statement pieces that we're going into, and just continue to think of it in terms of how it applies to a fashion company, which is actually a very good example with these items. And I will continue with the income statement structure.